So, what if you could live off your investments without ever having to sell them? I mean, for anyone even thinking about retirement, that's pretty much the dream, right? Getting a steady, predictable income stream while your nest egg just keeps on growing. It sounds amazing, but how on earth do you actually pull that off? Well, the source material we're digging into today lays out one really interesting strategy for doing just that.
So let's start with the big question, the one that's probably on a lot of people's minds. How can you fund your retirement without slowly bleeding your portfolio dry? I mean, it's a huge dilemma. You spend decades of your life building this thing up, and now you need it to take care of you, hopefully forever.
When you really boil it down, you've got two main paths you can take. The first option is the one we all hear about, the liquidation model. It's where you sell off a little piece of your portfolio every year, maybe you follow something like the 4% rule, just to cover your living expenses. But option two is a totally different way of thinking. You don't sell a thing. Instead, you build a portfolio that's designed to generate enough income all by itself, leaving your original investment completely untouched.
Okay, so how do you actually make that second option a reality? Well, this source we're looking at proposes a really specific solution, and it gives it a pretty memorable name, becoming a stocks landlord.
And the whole strategy really clicks when you think about this analogy. I mean, we all get how a real estate landlord works, right? You own a house, you rent it out to a tenant, and you collect a rent check every month. This strategy just takes that exact same logic and applies it to the stock market. But instead of houses and apartments, your assets are stocks.
All right, so if you're not knocking on doors collecting rent checks, where does the money actually come from? Well, this model is built on three different what they call pillars of income. So here's how the whole machine works. First up, you've got capital gains. This is pretty standard. You own good, high-quality stocks that you expect to grow in value over time. Second, there's dividend income. This is just the cash that solid companies pay out to their shareholders, kind of like a thank you for being an owner. And third, and this is the really unique part of the whole puzzle, stock rental income. This is the actual rent you collect for letting someone else use your stocks. Now, to make that second pillar, the dividend one, really powerful, this strategy focuses on a very specific kind of company, a dividend aristocrat. These aren't flashy startups. We're talking about huge, stable, established companies that have a proven history of not just paying their dividends, but increasing them every single year for at least 25 years in a row. Talk about reliable.
So what in the world is that rental income? Well, it comes from a strategy called selling covered calls. But let's just stick with the landlord idea. Think of it like this. You agree to sell your stock to someone, but only if it hits a higher price by a certain date. And just for giving them that option, they pay you a fee, a premium, right here, right now. That fee is your rent, and the best part? You get that cash up front, whether the stock's price actually goes up or not.
Okay, so that's the theory, a three-part income machine. But how does a strategy like this really stack up against something much, much safer, like, say, a bank CD?
The source lays it out pretty clearly. With a bank CD, you know exactly what you're getting. It's a fixed interest payment, the risk is super low, but it gives you zero protection against inflation, and your original money doesn't grow. Now, the stocks landlord strategy. It's aiming for a much higher yield, it's got built-in inflation protection because those dividends tend to grow, and you still have the chance for your stocks to appreciate. But, and this is a big but, there's a trade-off.
And here is the absolute key. This is not a risk-free strategy. It accepts what's called moderate volatility risk. Stock prices go up and stock prices go down. That means the total value of your portfolio is going to bounce around. You're basically trading the absolute rock-solid safety of a CD for the potential to get much higher income and growth.
So we get the strategy, we understand the risks. Now, let's see what happened when this thing was actually put to the test. The source gives us a really detailed proof of concept, and it starts with a long-term simulation that even includes a major stress test. All right, so take a look at this first chart. It's a 10-year projection of the portfolio's total value. Now notice what happens in year 7. Bam! They simulate a recession, and the portfolio's value takes a massive hit. It drops from over 1.7 million all the way down to under 1 million. That's that volatility risk we were just talking about, right there in black and white. But now, look at this. This chart shows the annual income that same portfolio generated. During that exact same recession in year 7, the income, it dips a little, but it doesn't crash. It stays incredibly stable, pretty much just dropping back to where it was in year 1 before it starts climbing again. This right here is the whole point of the strategy. The income is designed to be resilient, even when the portfolio's value is getting hammered. And the final numbers from that simulation are pretty eye-popping.
We're talking about an average annual income of over 15%, which adds up to almost $2 million in cash over 10 years. And during that huge market downturn, the income only fell by 22%.
Okay, so that was a simulation, but the source also gives us the results from a one-year, real-money proof of concept. This table here compares what they projected the income would be at the start of the year versus what they actually generated 12 months later.
So, the initial projection was for a pretty ambitious 13.5% yield. The actual result after 1 year in the real world? 18.89%. The strategy didn't just hit its goal, it completely blew past it. Mostly because that stock rent came in higher than expected and they reinvested the dividends.
So, when you boil it all down, what's the real philosophy here? It's all about a shift in your focus. Instead of getting obsessed with the daily ups and downs of your portfolio's total value, you prioritize one thing above all else: building an engine that generates the highest, most consistent cash flow possible from your assets.
And that leaves us with a final, really interesting question to think about. We're so often taught to focus only on total return and making our portfolio grow bigger. But maybe, just maybe, what this strategy suggests is that the real key to a resilient long-term approach isn't about the size of the portfolio, but about the strength and consistency of the income it can provide you year in and year out. It's definitely something to chew on.